Hello, and welcome to the Safri Private Wealth Podcast. I'm Leonora Stevens, a private wealth partner based in Bristol. I'm joined by Mike Hodges, a fellow private wealth partner based in our Manchester office. Hello, Mike.
Hi, Leo.
Join us each episode for in-depth discussions on private wealth matters, from estate planning and trusts to retirement and gifting strategies. We're here to provide practical tips to help grow and protect your wealth. And please don't forget to subscribe on your preferred podcast platform. Today, we are talking about how to approach an HMRC inquiry, or compliance check as they are now known. This podcast refers to how to approach an inquiry into a personal tax return, so we won't be covering inquiries into corporate related matters. It can feel very daunting and overwhelming when you receive a brown envelope in the post from HMRC, but with the right approach, it can be faced head on and without any panic. HMRC do have a year to inquire into return following its submission, as a large number of the more complex returns tend to be submitted in January due to its complexities. We often receive quite a few inquiries in the month of January, which is often unwelcome during the busiest time of the year for our tax team. So in this podcast, we'll discuss what an inquiry is, why it can happen, and what your rights and responsibilities are. So Mike, let's get started. Do you want to start with what an HMRC inquiry or compliance check is?
Yeah, it's, as you say, it's that brown envelope arriving from HMRC, isn't it? It's, I guess, in our world, divided typically into two. There can be what we would call an aspect inquiry, where perhaps you've undertaken a transaction and HMRC have got particular questions about that transaction, nothing else on your return. So I've had a number of those over the year. They just want to understand the big event that's happened in the year, and they'll typically ask for documentation and what have you that gives them a better understanding of what's happened. Because, just to digress for a second, because the tax return is actually quite a brief summary of 12 months of activity, and a lot of it, including the capital gains pages, don't necessarily have a huge amount of detail on them. So that's why HMRC might just say, in all innocence, we want to understand what's gone on. Slightly different from that can be what we would call full inquiry, which is essentially HMRC saying, we want to look at everything underlying that tax return for that year. Now, that could be because they've had information from some other source, because we live in a world where everything's much more connected than perhaps it once was. So you don't know where they've had their information from. And if you're then going international, different tax authorities across the world share information with each other. So that could be that. Again, I'd say don't worry, because that's what we're here for, to sort these things out. The mystery of it is that HMRC aren't required, and in fact they won't tell you why they've launched the inquiry, because the whole beauty of self-assessment, where the taxpayer or us acting for the taxpayer submits the return, is that HMRC then have this, well, we've got some questions. So you'll never find out what happens or why they've inquired into you. You might just be a random pig, but sort of like reverse national lottery territory. And then there are some taxpayers where, and I guess perhaps they're a feature of our world more than the generality, who are looked after by a high net worth unit. You might have your own dedicated team who will ask you more specific questions, again, just because they want an understanding and not necessarily because there is something wrong.
It's interesting also because you're saying about, for example, the aspect return as well, where, when we send a tax return to a client, we include the backing schedules. So you can see the tax return, you can look at the schedules and say, okay, that figure of bank interest is £2,000, and you've got the breakdown of which account it comes from at the back, whereas that doesn't go to the revenue. Only the capital gains tax pages tend to go. That can add to the complication.
And just as an example, we had a silly one where our client had sold shares in their business. HMRC inquired. One of the questions that they asked was, well, your client received X. Looking at the accounts of the acquirer, that shows a cost of investment in the acquirer's balance sheet of X plus. And we said, well, that's just because they have capitalized not just the X price paid, but all the legal and professional fees of doing that transaction. So I think the inspector there had thought, well, we're onto a winner here because there's something missing. They really weren't. And it was a very, very simple explanation. So sometimes it's a bit of a something and nothing, but it's just worth dealing with these things properly. And just before we came on, I was saying, there are two schools of thought. Some people get very aggressive. HMRC are this and see them as it were the enemy. I try to take they're doing their job, we're doing our job. Let's be civilized. Let's try to be as cooperative as we can, because we want to get a good answer in an amicable way. And I've always felt that gives you a bit more flexibility, a bit more put the someone's back up where all they are doing is their job. But that's a whole difference of approach and emphasis, and everyone's different. That's just my personal take on.
But I think also, if I look at the last few inquiries I've had over the last sort of 18 months, all of them we have been correct. It has just been HMRC asking for more details. In which case, that plays to your point. Let's be cooperative and collaborative, and then it can be sort of nipped in the bud as quickly as possible.
Yeah, no, definitely. And then I suppose the other thing, which is a more recent development, is not necessarily a full inquiry or an aspect inquiry, but these so-called nudge letters. So HMRC will write you a gentle reminder to say, are you sure that you've included everything on your tax return? And they're just sort of encouraging you to go back and double check, make sure you haven't missed anything in a sort of an innocent way, but there you go. So that's just a modern development, and I think that's trying to influence people's behaviour to be more compliant. So that's the way sometimes it works. And I know there are different views about, do you respond to those letters and say, yes, we've checked and it's all right, or do you just ignore them? Because you'd say, well, look, all we had to do on behalf of our client was file a tax return. We've done that. If you want to find out more, make a formal inquiry or start an official compliance check. But again, if it's a gentle, yeah, we've checked and it's all right, do you lose anything from that? I don't know. It's tactics and approach in discussion with the client to make sure you get the best outcome in the circumstances. And as you say, Leo, mostly we're right, you're wrong. But fingers crossed. That's probably been very brave if there'll be something that crops up between now and January on one of mine that we've gone wrong. Let's hope not. So just a sort of background, Leo, HMRC do have rights and powers, and just do you want to talk about what taxpayer clients should be aware of in that sense?
Yeah, sure. So key thing is if you receive a letter, a compliance check from HMRC, are they in time to inquire into your return? So if your return was submitted within the last 12 months, then yes, they are. And so it's just making sure that they're not going outside the scope of their permitted time frame to inquire. So that's one point. Then HMRC are allowed to request certain documentation that is reasonably required for the purposes of their check. So, for example, if they were inquiring into expenses you had as a sole trader, they might want the invoices, whereas they can't then say, we'd really like a copy of your investment tax packs or trustees relating to any trusts that you've created, because sometimes they can just throw a massive sort of blanket information request out when actually it's not specific to what they're looking into. And so you can push back on that. And we have in many cases pushed back where they've asked sort of slightly outside of the scope information, because not only will it not add to what they're asking to, it's also costing the client a lot of money in gathering all the information. So just be aware of that. Is the information that they've requested reasonable, relevant, and for the period under review as part of the compliance check? Then the other thing is, which is really an easy one to hopefully keep on top on and not miss, is about the deadline for a response. So normally they will give you potentially quite a short turnaround time, but as I said earlier, they often come out in January, at which point all hands on deck to get tax returns done. It's very difficult to potentially gather the information in time. But they are open to, they are flexible. If you contact them and request an extension, then 9 times out of 10 they will do so. But the key is, don't miss your extended deadline. Just make sure that you get that information in when you can. Those, I think, are the key things that I would tell people to look out for if they get one. But then, Mike, what happens if HMRC, I know we've said that we don't think of the ones that we've had, touch wood, that we haven't had any mistakes, but what happens if they do find a mistake with your return, and how can you try to avoid the mistakes or mitigate?
Well, I guess we're getting onto the sort of slightly tricky territory of penalties. And again, it's not black and white. HMRC will look at all of the facts, but they basically divide things into three. So if you took reasonable care, but a mistake snuck through, then there's no penalty. As long as you told the revenue as soon as you found out. If you sort of sat on it for a while, then told them, then you could be in for a penalty. Then they talk about careless behavior and their example. And their examples aren't great because I think these are so fact specific, but their example is a simple transposition or arithmetical error that you couldn't have spotted just by reviewing something. And they will then say, depending on all of the facts, it's a 0 to 30% penalty if you've come clean without them prompting you. You're in different territory on all of these if you've only told them because they asked a question because they've issued an inquiry, in which case that's what we would call prompted, and that's probably a 15 to 30% penalty. So that's for where you're careless. And then deliberate behavior, they divide into two. something that's deliberate and something that's deliberate and concealed. And you won't be surprised to know that deliberate and concealed, actually the penalty can be 100% of the tax. But you are then getting very close to really bad behavior, aren't you? So that's not where you want to be. But again, for unprompted, you could be as low as 30%. So I'm not quite sure in what situation you'd say, well, it was deliberate, it was concealed. And then I suppose you have a twinge of conscience over the Christmas turkey. I'm going to fess up here. So even that's a huge range, 30 to 100. So it does then warrant some serious thinking about deliberate behavior, which is not concealed. You're in the range 20 to 70. Again, the huge range. And it'll so much depend on, was it unprompted, and how straight you are with HMRC during the process. So if you then say, sorry, hands up, I'll tell you everything, you're in a much better position. Don't try and hide things. And there wasn't there? Nothing to do with you or me. I've just come into my head. The whole Lester Piggott thing where he'd had a big tax inquiry, all sorted, all settled. And then whether this is urban myth or not, I'm not quite sure. But rumour has it that when he came to write the cheque to settle his tax, he wrote it from a bank account he hadn't disclosed to HMRC. And that's where it all goes, as you can well imagine, with some justification, horribly, horribly, horribly wrong. Don't go there. And the other story from my part of the world, of course, is Ken Dodd, prosecuted by HMRC, but prosecuted in front of a Liverpool jury and was acquitted. And I wasn't there, but I was practicing tax at the time. He was then the guest of honour at the following year's Chartered Institute of Tax and I think spoke for hours and hours and hours, but there's a whole other story again. And just one other aspect on this whole story of penalties, if you get into offshore matters, I suppose because HMRC are sensitive to, are people hiding income, not disclosing it, and it's offshore, then the penalty can be 200% of the tax. That's just to make sure that they're encouraging people to do the right thing when they think otherwise you might think you've got away with it. But keep calm. We're here to help you. And mostly it doesn't get anywhere near the bad thing. But we have to warn people that if you're at the wrong end of this, the penalty can be quite bad.
There are sometimes, often genuine mistakes, and that people shouldn't fear that. The revenue can be quite receptive to that, and mistakes happen, but they can be rectified. But also, if people are, for example, in the midst of preparing their 24-25 return, you do still have 12 months after to amend the prior year. So if you happen to notice that there was a mistake in a prior one, you still have the right to amend that tax return. If I've had other clients where they've realised that there was a mistake, previous accountants, and then we've helped them disclose that to HMRC, and they, we sort of, the clients put their hands up and said, look, as soon as I spotted the error, I've disclosed it, and it's all been sorted quite promptly.
And I guess, Leo, just to be clear, the 12 months is if you have disclosed everything properly on your tax return, because at the other end, where, heaven forbid, I've never come across this, if you get something that's fraudulent, then HMRC have 20 years, and for deliberate, you can be in a 4 to 6 year period, because again, the onus is on us. It's self-assessment. It's the onus is on the taxpayer to tell the revenue what the revenue needs to be to know. So you can't get away with it just for saying, well, I won't put anything on my tax return, and then 12 months isn't going to apply. So you're going to be in deeper waters than that.
I think also I've had a few instances where the revenue, as say, a client's probably first reaction when they receive the letter is, oh no, something's gone wrong, when actually it might not necessarily have done, where people have got their names associated, for example, if they're trustees. And so when the 60-day capital gains tax reporting rules came out, when you make a gain on the disposal of a property, and I think the revenue were going through Land Registry to see where names were cropping up, and then looking at tax returns saying you have not disclosed a capital gain arising, but actually their name was on it as a trustee, not in a personal capacity. And so the two weren't marrying up, which is where we get, I think that is probably a common area, is where people are named as in a different, not holding items in their own name, but say as trustee.
I've had that more than once. Absolutely. Yeah.
So there's one. And then going back to one of the original points we were saying about how HMRC won't tell you what they're trying to inquire into. I had a client many years ago, and the revenue made contact saying, we'd like to inquire into the level of your bank interest. Please, can you provide the certificates? And so we went to all the different banks, requested the information, or double checked that we had included everything. And yes, we sent it in. They asked about 3 times, and it turned out that one interest certificate, a sizable 6-figure amount, had been left off, on the tax return, which actually we had requested all the relevant information, and actually for some for some reason it hadn't been included. But there they were adamant they would not tell us what they were trying to get at. So sometimes it's a bit of a sort of it's a puzzle trying to work out what angle they're trying to go for.
Yeah. And I had one where sometimes it works in your favor. Client had sold his business. He sold it for loan notes, essentially the buyer saying, here are IOUs. And he'd sent a schedule of the interest that he'd received on those loan notes, those IOUs, which we dutifully put onto his tax return. HMRC inquired and said, are you sure you've got all of the interest there? And then when the client did a deeper trawl through it, he discovered that a number of those interest payments weren't actually interest payments, they were repayments of capital, i.e. amount of the outstanding loan. So we ended up writing a letter to HMRC saying, well, we've now fully inquired into with our client and got a full analysis, and you owe us. And it was a big 6-figure number. And there's a certain amount of, quite enjoy that one. Because we then had, and we had to make sure we'd got copies of all of the documentation, because you're not going to go off, without being absolutely certain of your ground there. But I quite like that one. It's sort of one of those that sticks in your mind. Otherwise, fingers crossed, touch wood. Yeah, we've had reasonable experience of inquiries because, when we're filing returns, we're trying to get them right first time. So the inquiries shouldn't be something that will come as a huge surprise.
But I suppose
So,
the key message is, isn't it? It's keep calm and speak to your tax advisor if you get a letter in the post. And I say hopefully it all will be resolved relatively simply and
yeah,
promptly. But
yeah,
say keep calm.
absolutely right. They can't.
On that note, so that's all for this episode of the Safri Private Wealth Podcast. Many thanks to Mike for joining me today. At Safri, we work with a wide range of clients, both in the UK and overseas. We advise individuals and families on how best to safeguard, maintain, and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax laws in the UK, which can be complex. It's important for me to mention that if you're considering any of the topics discussed today, you must always take professional advice based on your own circumstances. If you'd like to find out more about the services we offer at Safri, then please do visit our website at www.safri.com. And don't forget to subscribe on your preferred podcast platform and leave us a review if you found this episode helpful. Thank you for listening.